Imagine facing a medical emergency, maybe a serious diagnosis that needs really expensive treatment, and you think you're covered. You join this plan, through community, shared beliefs, thinking you're part of this system where members help each other out with medical costs.
The kind of mutual aid, really.
Exactly. But then the hospital bills start rolling in, and instead of getting paid, they just pile up. Suddenly you're getting calls from debt collectors, your credit's tanking, you're facing, financial ruin. And at the same time, according to some pretty detailed investigations you sent us, the people running some of these very organizations were allegedly siphoning off millions, buying private airlines, banks.
It's a stark contrast, isn't it? The ideal of community support versus this much harsher reality that some people apparently faced. The source material really shines a light on that.
It really does. And that's exactly what we're diving into today. Health Care Sharing Ministries, or HCSMs here in the U.S. You, our listener, gave us just a ton of information articles, research reports, investigations from places like ProPublica, KFF Health News, CBS News, the Commonwealth Fund, King 5, Wikipedia. A lot to unpack.
Yeah, quite a stack. So our mission here is really to get into these sources. We want to understand, okay, what exactly are HCSMs? Where did they come from? How did they grow? How do they actually work day to day? And crucially, how are they different from regular health insurance?
And the risks involved too, right? That seems huge.
Absolutely. The risks, the regulatory side of things, or maybe the lack thereof, and we need to look at real member experiences, the good and the bad, plus those serious allegations of, financial mismanagement in some cases. We want to pull out the key insights from everything you sent to give you a really solid picture.
Okay, let's start right at the beginning. What exactly is a healthcare sharing ministry? How do the sources define it?
Well, broadly speaking, the sources describe them as organizations where the members basically agree to share each other's medical bills.
So like a collective pot for healthcare costs.
That's the core idea, yeah. Across the sources, Wikipedia, Decent, the Commonwealth Fund, the definition is pretty consistent. It's a group of people who've agreed to help pay for each other's medical expenses, and usually this agreement is based on shared ethical or religious beliefs.
Religious beliefs seem pretty central based on the material.
Very central, especially for the bigger, older ministries. MediShare, Samaritan Ministries, for example. The sources point out they're explicitly founded on New Testament biblical principles. Members typically have to agree to specific Christian faith statements to join.
Okay, so this sharing, it's not just a vague concept. There's an actual financial mechanism.
Oh, yeah, absolutely. Instead of paying a monthly premium like you would for an insurance policy, members make these regular payments, usually monthly, called shares.
Right, shares, not premiums.
Exactly. And those shares are then intended to cover the eligible medical bills of other members in the group. Now, how that actually works can vary a bit. Some ministries, the Commonwealth Fund describes this, have a direct sharing model. So if you need funds, they might literally match you with other members who send their monthly share payment directly to you.
Oh, interesting. Like person to person.
Kind of, yeah. Others operate more like a central pool. They collect all the shares into one account, and then the ministry administrators pay out eligible expenses from that pool. Both ways, though, the fundamental idea is members contributing together to help others with their bills.
Okay, got it. Now, before we go any deeper, what's the one thing, the really critical distinction that all the sources just keep emphasizing about HCSMs?
This is it. This is the absolute key takeaway, and you see it everywhere. King 5, Decent, Commonwealth Fund, Wikipedia, even MediShare's own materials point this out. HCSMs are not health insurance.
Not health insurance.
Not health insurance. And that's not just semantics. It's the fundamental difference. Insurance is a legal contract. It guarantees payment for covered services according to the policy terms. HCSMs, on the other hand, do not guarantee payment.
No guarantee, even if the bill seems to fit their rules.
No guarantee. They are voluntary sharing arrangements. There's no legal obligation for the ministry to pay your bills, even if the need seems eligible under their own guidelines. This lack of a guarantee is, it's everything. It explains both why some people are drawn to them and why there are such significant risks.
So you pay your monthly share, hoping that if you need help, the money will be there, and hoping the ministry decides to share it for your need. But there's no actual promise. That feels worlds apart from an insurance contract.
It is worlds apart. And anyone even thinking about an HCSM needs to have that difference crystal clear in their mind from the start.
Okay, let's rewind a bit. How did these ministries even come about? This idea of pooling resources isn't exactly brand new, is it?
No, not at all. The sources, like Wikipedia and ProPublica, trace the roots back, way back actually, to the early 1900s. You had communities like the Amish and Mennonites, right? Strong traditions of mutual aid. They would pool money informally to help members through tough times, including sickness or accidents. It was just community self-reliance.
So the basic concept existed long before the modern healthcare system.
Exactly. But the HCSM movement, as we sort of know it now, specifically within the broader Christian community, really picked up steam later in the 20th century, often as a response to rising healthcare costs, but also maybe reflecting certain cultural or religious viewpoints.
Any specific origin stories?
ProPublica's investigation points to one early influential example, Bruce Hawthorne and something called the Christian Brotherhood newsletter back in the 1980s. Apparently, Hawthorne's family faced huge medical bills after a serious car accident, and the community rallied around them, helping to cover the costs. That experience reportedly inspired him to create a more structured way for Christians to share medical burdens.
So taking that old community aid idea and giving it a more formal structure.
Pretty much. But as these groups grew, started collecting money from more people across wider areas, they started looking, well, a bit like insurance companies in practice. And that, predictably, caught the eye of state regulators.
Uh-oh, trouble brewing.
Yeah, some early ministries faced legal challenges. Wikipedia and ProPublica mention states questioning whether they were essentially selling insurance without a license, which is illegal. The Christian Brotherhood, for instance, argued they weren't insurance because in their model, the members supposedly controlled the money, not the central organization. That was a key argument to try and avoid state insurance laws.
And did that argument work?
Well, it led to a different strategy. Instead of trying to fit into insurance regulations, the ministry started lobbying state legislatures. They pushed for specific laws to exempt them entirely from being regulated as insurance.
The safe harbor laws.
Exactly. These laws basically carve out an exception for HCSMs. ProPublica notes that by '94, about 10 states had these exemptions. Fast forward to 2018, and the Commonwealth Fund's data, they have a chart. Exhibit 1 shows 30 states had these kinds of safe harbor rules.
30 states. So what do these laws do?
Typically, they require HCSMs to put disclaimers on their material saying very clearly this is not insurance. But the flip side is these laws shield them from most, if not all, of the state's insurance regulations, the rules about financial reserves, what benefits must be covered, consumer protection standards. All that stuff insurance companies have to follow.
Okay, that's a huge development. And then the Affordable Care Act, the ACA, in 2010.
Yeah.
That seems like another massive turning point based on the sources.
Oh, absolutely pivotal. Maybe the most pivotal moment for their growth. Remember the ACA's individual mandate? The requirement for most people to have health insurance or pay a penalty. Well, the ACA included a specific exemption from that mandate for members of qualifying HCSMs. King 5 and ProPublica report this exemption was pushed for by Republicans and various religious groups. Suddenly, HCSMs had this federal stamp of approval, in a way. They were a legally recognized way to avoid the mandate penalty without buying traditional insurance.
So the ACA, ironically, gave them a huge boost.
A massive boost. Even though the federal penalty for the mandate eventually went away in 2019, that initial ACA exemption really put HCSMs on the map for a lot more people. It legitimized them as an alternative in many eyes, and as ProPublica put it, it propelled the industry's growth.
Propelled is right. What kind of numbers were we talking about?
The growth was explosive. Sources like Wikipedia, the Commonwealth Fund, ProPublica, they estimate membership went from maybe under 200,000 people before the ACA passed in 2010 to potentially hitting 1 million members by 2018.
Wow, from 200,000 to 1 million in less than a decade.
Yeah. And more recently, KFF Health News and CBS News cited some Colorado data suggesting total HCSM membership could be over 1.7 million by 2023. That kind of rapid expansion really seems tied in large part to that ACA exemption and the visibility it gave them.
Incredible growth. Okay, so let's get into the nuts and bolts of how they actually function now, especially focusing on those critical differences from insurance that people really need to grasp. We mentioned the monthly shares are often cheaper than insurance premiums, especially if you don't get subsidies.
That lower monthly cost is definitely the #1 draw for many people. Sources like Decent, MediShare, Commonwealth Fund all highlight this. If you're buying insurance on your own without significant help from ACA subsidies, an HCSM can look much, much cheaper month to month.
And they have something like a deductible too, right? An amount you pay first.
Yes, exactly. Before the ministry starts sharing costs for eligible needs, the member has to cover a certain amount themselves first. Different ministries call it different things. MediShare calls it an annual household portion. or AHP. Others might call it an initial unshareable amount, or IUA. You can see examples in the Commonwealth Fund's Appendix 2. Functionally, it's very similar to an insurance deductible or maybe an out-of-pocket maximum. You pay this first chunk of costs.
Okay, so lower monthly payments and initial amount you pay.
Yeah.
But this is where the confusion really starts, isn't it? Because the sources say HCSMs use a lot of features that make them look very much like insurance products.
This is a huge issue, and state regulators cited in the sources bring it up constantly. The Commonwealth Fund report lists a whole bunch of these similarities. You've got the defined monthly payments, right? A formal process for submitting your medical bills that feels a lot like filing an insurance claim. They often have benefit schedules saying what kinds of needs might be shared, sometimes even preferred provider networks, lists of doctors and hospitals they encourage you to use.
They even pay brokers commissions.
Some do, yes, paying commissions to insurance brokers who then sell HCSM memberships alongside actual insurance plans. And some ministries even market different levels of participation using terms like gold, silver, bronze, which directly mimics the ACA's metal tiers for insurance plans.
Wow, gold, silver, bronze. That's really borrowing the language.
It absolutely is. And then add in the fact that they often market heavily during the annual open enrollment period, at the time when people are specifically shopping for health insurance. All of this together creates a very real potential for confusion.
It almost sounds like they're trying to blur the lines intentionally.
Well, state regulators certainly express concern that this similarity is misleading. The Commonwealth Fund mentions regulators getting more calls during open enrollment from people who bought an HCSM plan thinking it was insurance and were shocked, usually when a bill arrived, to find out it wasn't.
Which brings us right back to those fundamental critical differences that stem from them not being insurance and being exempt from those ACA consumer protections.
Yeah.
Let's hammer these home. Number one, again, no guarantee of payment.
Yes. Worth saying over and over, it is the absolute bedrock difference. Insurance companies have a legal contract to pay valid claims. HCSMs do not. King 5, Decent, Commonwealth Fund, all clear on this. Payment is voluntary and not guaranteed, even if the need technically meets the ministry's own sharing criteria.
Okay. Second big difference, they don't have to cover essential health benefits, those minimum coverage standards required for ACA insurance plans. What does that mean practically?
It means they can choose what they want to share or not share, and they often do exclude or severely limit things that ACA plans must cover. The Commonwealth Fund Appendix 2 gives real examples based on ministry guidelines, things like mental health care, treatment for substance use disorders, routine preventive care, vaccinations, cancer screenings, and often prescription drugs, especially outpatient ones. Some might only share drug costs if you're actually admitted to the hospital.
So really basic, necessary stuff might just not be shareable at all.
Exactly. You could be left holding the entire bill for very common, very necessary types of medical care. It's a huge gap compared to comprehensive insurance.
And pre-existing conditions. That's another massive area of difference, right? The ACA famously banned denying coverage or charging more for them.
Right, and this is a major risk with HCSMs, highlighted across the sources. They can, and often do, limit or entirely exclude sharing for pre-existing conditions. Again, the Commonwealth Fund Appendix gives examples. They might have look-back periods, meaning if you receive treatment for a condition in the, say, 2 or 3 years before joining, it's excluded for a time, maybe permanently.
Or you have to wait years.
Yeah, 10-year requirements are common. You might have to be a paying member for, say, 1, 2, even 3 years before a pre-existing condition becomes eligible for sharing. And even then, it might only be partially shareable, maybe with a lower annual cap just for that condition.
Are there specific conditions they call out?
Sources mention examples like type 1 diabetes sometimes being excluded, or specific limitations for tobacco users over 50 if they develop certain heart conditions or cancers. And unlike ACA plans, some HCSMs can actually deny membership altogether based on your health history revealed during a medical screening, or they can charge you higher monthly shares if you have certain conditions. None of that is allowed for ACA-compliant insurance.
So if you have any kind of ongoing health issue, even something well-managed, joining an HCSM could mean you get zero help with those costs, possibly for years or maybe even ever.
That's the reality. The risk of managing and paying for chronic conditions often shifts entirely back onto the member.
Okay, what about limits on how much they'll pay out? Annual or lifetime caps? The ACA banned those for essential benefits and insurance plans.
Correct. But HCSMs are not banned from using them. They can place annual limits on sharing, or more commonly, lifetime caps on the total amount they will ever share for a member's medical bills.
What kind of limits are typical?
The Commonwealth Fund Appendix 2 gives examples. A $1 million lifetime cap per member seems fairly common in some ministries' guidelines, but sources also detail limits on specific services, like maybe only 20 therapy visits per year, or a maximum dollar amount for maternity care, sometimes even limits per illness or incident.
And $1 million sounds like a lot, but
It does, but as the Decent and Commonwealth Fund sources point out, a single catastrophic event, a terrible accident requiring multiple surgeries and long rehab, a really complex cancer diagnosis needing specialized treatment, a premature baby needing months in the NICU, those situations can unfortunately blow past a $1 million limit surprisingly quickly. You could be left personally liable for hundreds of thousands, even millions more.
that's terrifying. That's a level of financial risk that ACA insurance is designed to prevent.
Exactly. It's a risk that simply doesn't exist for essential health benefits covered by compliant insurance plans.
Beyond coverage and money, there are also differences in just who can join and what's expected of members, right?
Yeah, absolutely. Membership isn't typically open to just anyone like insurance generally is. Sources like Wikipedia, Decent, King 5 note you usually have to attest to sharing the ministry's specific religious or ethical beliefs. For the big Christian ministries like MediShare or Samaritan, this means signing a statement of faith, agreeing to live by certain biblical principles, often including things like abstaining from tobacco, illegal drugs, maybe limits on alcohol, specific views on marriage and sexuality.
And some might screen for health.
Some might, yes. Wikipedia mentions that some HCSMs may require applicants to be in generally good health to even be accepted for membership.
And this point from the KFF Health News CBS News piece really stood out to me. Some HCSMs apparently require members to ask for charity care or discounts from doctors and hospitals before they even submit the bill to the ministry for sharing.
Yes, that was a fascinating detail. The article quotes an HCSM executive explaining this. They framed it as members needing to be good stewards of the shared money. The comparison made was something like asking for help from a soup kitchen before asking the ministry to share.
Wow. So the ministry isn't the first resort. It's almost the last resort after you've tried to get free care.
That seems to be the philosophy behind that requirement in some cases. It really underscores that this isn't insurance, where the plan pays first according to the contract. It reinforces the idea that the primary responsibility for the bill lies with the member, and the ministry is there to help share what couldn't be covered through other means, including charity. It really flips the expectation compared to insurance.
It really does. Okay, one more distinction. Nonprofit versus for-profit. Most HCSMs are nonprofits, while most insurance companies are for-profit. MediShare, for example, highlights this, suggesting their focus is on members, not profits.
That's the argument they present, yes. Being nonprofit means, in theory, there are no shareholders demanding profits, so more money should go towards the mission of sharing bills. However, and this is a big however based on the sources, the nonprofit status doesn't automatically prevent potential problems, especially when you have limited regulatory oversight. As the investigations we'll discuss later seem to suggest, allegations of financial mismanagement can still arise.
Which leads us perfectly into the next big area. The risks and the really tricky regulatory landscape these ministries operate in. We keep mentioning consumer confusion, but it seems like it's worth stressing just how big a problem this is.
And it's probably the most widespread risk, potentially affecting, well, millions of people now, given the enrollment numbers. You've got these plans that look and feel like insurance in some ways. They cost less per month. They're marketed heavily, sometimes by insurance brokers. It's just a recipe for misunderstanding.
And regulators see this firsthand.
Constantly. The Commonwealth Fund report is full of quotes from state insurance regulators expressing deep concern about this. They say consumers frequently buy HCSM memberships thinking they've bought real insurance, and they only find out the truth when something bad happens, they get sick, they have an accident, and the bills don't get paid as expected.
And trying to oversee these groups is tough for the regulators.
Incredibly tough. The Commonwealth Fund piece lays out the challenges. One huge problem is just a basic lack of data. Regulators often have no idea how many people in their state are enrolled in HCSMs or how the ministries are actually operating financially. They don't get the detailed reporting that insurance companies have to submit.
So they're flying blind to some extent.
To a large extent, yeah. They often only find out about problems when consumers complain, and many consumers might not even know who to complain to since it's not technically insurance. Plus, state insurance departments often have limited staff and budgets, and they face political headwinds if they try to crack down on organizations that state law has specifically exempted.
And there's another concern mentioned that HCSMs might actually be harming the traditional insurance market.
Yeah, this is the worry about market segmentation, which the Commonwealth Fund report discusses. The thinking goes like this. Because HCSMs can offer lower monthly costs, partly by covering less and excluding sicker people, they might attract a disproportionate number of younger, healthier individuals away from the ACA marketplace, especially people who don't qualify for subsidies and face the full premium costs.
So the healthy people leave the ACA pool.
If enough healthy people leave the regulated ACA market, the pool of people left behind becomes, on average, smaller and sicker. And that drives up costs for everyone remaining in the ACA plans, leading to higher premiums, maybe fewer insurance companies willing to offer plans. It potentially makes comprehensive insurance less affordable and accessible, especially for people with pre-existing conditions who rely on those ACA protections. The report specifically mentioned Alaska as a state where HCSM enrollment is thought to be pretty significant compared to the size of their individual insurance market.
So even if regulators do see problems, like misleading marketing or failure to pay, those safe harbor laws really tie their hands.
Often, yes. That's another key point from the Commonwealth Fund. In states with these exemptions, regulators usually can't take action just because a ministry didn't share a member's bill. That's generally allowed under the exemption. To step in, they typically have to prove something more specific, like deceptive marketing, proving the ministry explicitly misrepresented itself as insurance, or outright financial fraud.
And sometimes the laws get even weaker.
The sources mention cases where, after regulators did try to increase oversight or take enforcement action, the state legislature actually responded by strengthening the HCSM exemptions, making it even harder for regulators to intervene in the future.
Okay, let's look at some specific examples of regulatory actions the sources mentioned, just reporting what they found. Washington State seems active. King 5 reported the insurance commissioner there fined OneShare Health $150,000 back in 2021. What was the allegation?
They alleged OneShare was, quote, selling insurance illegally. OneShare didn't admit wrongdoing, but settled the case, according to King 5, agreeing to stop enrolling new members in Washington to avoid a legal fight.
And King 5 mentioned actions against other HCSMs in Washington, too.
Yeah, they listed several others the Washington Office of the Insurance Commissioner, OIC, had targeted, including Alira Trinity, that name comes up a lot, Makina Health, Alliance for Shared Health, Liberty Health Share, Zion Health, a product from Christian Care Ministries called ManaCare, and Unite Health Share Ministries. The common thread in many of these actions, according to King 5, seem to be allegations of deceptive marketing or operating beyond what the state's HCSM exemption allowed.
California also took action against Alira and Trinity, right?
Yes, the California Department of Insurance issued a cease and desist order against them. Wikipedia mentions this and cites a New York Times investigation suggesting that a very high percentage of the money members paid in was allegedly kept by the founders, not used for sharing medical bills.
Massachusetts did something different.
Yeah, according to a Boston Globe piece cited by Wikipedia, Massachusetts prohibited licensed insurance brokers from selling HCSM memberships. The idea was to prevent brokers from misleading consumers into thinking they were buying actual insurance.
And Colorado, the KFF-CBS News piece highlighted them.
Right. That article noted that Colorado regulators get regular complaints from HCSM members, and it made the striking point that roughly 1 out of every 4 people in Colorado buying health coverage on their own outside of employer plans is actually enrolled in a sharing ministry. That shows just how significant their market presence is there.
And looking back, Wikipedia mentioned earlier actions, too.
Yeah, Kentucky apparently issued a restraining order against MediShare way back in 2002, alleging it was unauthorized insurance. Oklahoma had a dispute with MediShare around 2007 over marketing, which was resolved when MediShare reportedly changed its approach to avoid looking like it was selling insurance. So these regulatory clashes over marketing and whether HCSMs are acting like insurers, they've been happening for a long time in different states.
Okay, those regulatory actions give us a sense of the systemic issues. But honestly, the things that really hit home are the personal stories, the experiences of individuals who are relying on these ministries. The ProPublica investigation, in particular, had several really powerful, difficult accounts. Let's share some of those, starting with Bonnie Martin.
Bonnie Martin's story, reported by ProPublica, is just. It's heartbreaking, and it perfectly illustrates that no guarantee reality. She joined Liberty Health Share, liked the community idea even though she wasn't particularly religious. Her cancer came back. Initially, Liberty helped with some bills, but then, according to the report, the payments just stopped. No clear reason given.
She was left with debt.
Yeah, $10,000 in medical debt that went to collections. ProPublica describes her making these desperate calls to Liberty while she was incredibly sick, pleading with them to pay the bills under immense stress. ProPublica confirmed she passed away in July 2022, and Liberty HealthShare never paid those outstanding bills. Her family was left with the debt. It's just a devastating example of needing care, thinking you're covered, and then being left completely adrift with crushing debt at the worst possible time.
Just awful. What about David Chalman? His story highlighted the financial ripple effects.
Right. Also from ProPublica, David Chalman joined Liberty, didn't like the ACA, considered himself healthy. He had a heart issue, and Liberty apparently paid those bills. But then he had a second, much more expensive cardiac event, over $150,000 in costs. Liberty didn't pay that.
$150,000. What happened?
The bills went to collections. His credit was destroyed. He told ProPublica he couldn't get loans, which was a factor in his business failing. And the really difficult part, he felt trapped. Even though Liberty wasn't paying this huge debt, he kept paying his monthly shares to them because he was afraid if he stopped, he'd lose any tiny chance he might have had of ever getting reimbursed. It shows how catastrophic costs can lead to financial ruin and how members can feel stuck even when the system isn't working for them.
And Heidi Dunfield's story showed just the sheer effort involved in trying to get paid.
Yeah, ProPublica reported she joined Liberty because regular insurance was too expensive. Her family racked up over $10,000 in medical bills that weren't getting shared, and those also went to collections. She described spending just countless hours fighting with Liberty, on the phone, sending documents, trying to navigate their process. And when ProPublica published, she was still waiting for payments. It just highlights the incredible personal burden and stress involved in trying to get these ministries to share costs, even for things that might seem eligible under their own rules.
And Marilyn Breck. Her story connected it to broader financial vulnerability.
ProPublica shared her experience, too. She had a $20,000 bill for a cancer screening that Liberty didn't pay. It went to collections, wrecked her credit. And at the time, she was already in a really tough spot financially, even using food banks. She just felt completely overwhelmed, unable to fight Liberty or the debt collectors while struggling just to survive. It shows how unpaid HCSM bills can push people who are already struggling over the edge.
There was also Laura Murray's story in the KFF Health News CBS News report. That seemed to show problems even when trying to follow the rules.
Laura Murray told KFF-CBS she picked Liberty because it seemed affordable and neighborly. But she ran into big problems getting bills paid after an unexpected pregnancy. They ended up in collections, and she said it took years to finally clear everything up. Now, Liberty disputed some details of her story. They suggested she hadn't provided all the needed documents or hadn't pre-notified them properly. But regardless of the exact details, her experience shows the kind of administrative nightmares and long delays members can face, leading to serious consequences like collections, even when they believe they're following the ministry's procedures.
These stories are just incredibly sobering. They really lay bare the potential consequences when the sharing doesn't happen as expected. But as you said, the sources did try to provide some balance. Not every experience is negative.
That's important to remember, yes. The KFF Health News CBS News piece, for instance, also shared a positive story from a member named Mike Quinlan. He had switched to Samaritan Ministries because his traditional insurance had really high out-of-pocket costs for the birth of his first child.
And his experience with Samaritan was good.
He reported it was very positive. Samaritan covered the costs for his later children's births. And because Samaritan uses that direct sharing model we talked about, he actually received checks directly in the mail from other members to pay his bills. He described feeling a real sense of community, getting cards and notes with prayers along with the money. His story shows that, yes, for some people, with certain ministries and for certain types of needs, the HCSM model can work as intended and provide that financial help and community connection people are looking for.
So it really is variable. Depends on the ministry, the specific need, maybe even luck sometimes.
Oh.
Okay, let's transition now to dig deeper into those allegations of financial mismanagement and lack of accountability. The ProPublica investigation into Liberty Health Share specifically provides a really detailed and frankly disturbing example.
It really does. It's a case study in what can potentially happen in this space with limited oversight. ProPublica connects the dots, starting with the history of the Beers family, who were key figures at Liberty. They link them back to that earlier Christian Brotherhood newsletter scandal in the 80s.
The one that faced allegations of fraud.
Yes. ProPublica reported the Brotherhood was accused of siphoning millions back then, leaving members with unpaid bills, and resulted in legal judgments against Daniel Beers.
But despite that history, the family got involved with Liberty after the ACA passed.
That's what ProPublica alleges, that the family saw the opportunity created by the ACA exemption and launched Liberty Health Share. Daniel Beers reportedly directed things behind the scenes, even without an official title at the nonprofit. Other family members and close associates were allegedly put into top executive positions, like CEO and VP.
And the core allegation is about where the members' money went.
Exactly. ProPublica's central finding is that Liberty Health Share allegedly paid tens of millions of dollars every year from member contributions to two for-profit companies that were controlled by the Beers family or their associates. One company handled marketing for Liberty, the other managed billing and member services.
How much money are we talking about?
The investigation estimated that between 2015 and 2021, Liberty paid over $35 million to the marketing firm, Medical Cost Solutions, and a staggering $105 million to the billing management company, Cost Sharing Solutions. And critically, ProPublica reported these family-controlled companies got essentially all their revenue from Liberty Health Share member share payments.
So money came into the nonprofit Liberty from members and then allegedly flowed straight out to these private for-profit family businesses.
That's the core allegation. And ProPublica reported this money didn't just sit there. It was allegedly moved through a network of shell companies and used to buy up a truly astonishing array of assets. They called it the conglomerate.
Like what kind of assets?
The list is wild. Reclaiming family ranch land, buying a private airline, a winery that was later apparently converted into a marijuana farm, butcher shops, a wedding venue, and maybe most eyebrow-raising, they acquired a bank. ProPublica even quotes Daniel Beers from a deposition saying, "Nobody's here to not make money," and an associate reportedly said, "Profit was the goal."
Profit was the goal in a non-profit sharing ministry system. And while this alleged conglomerate was being built, what was happening with members' medical bills?
That's the devastating connection. ProPublica found that while millions were allegedly flowing to the family businesses and assets, Liberty's payments to members for their medical needs fell further and further behind. This directly led to the kinds of stories we just talked about: members facing millions in unpaid debt, bills going to collections, financial hardship. The report even cited data from Massachusetts showing Liberty only spent about 56 cents of every dollar collected from members there on actual medical care, whereas regulated insurance usually has to spend at least 80 cents on the dollar.
56 cents on the dollar. Wow! The investigation also mentioned some questionable accounting practices.
Yeah, ProPublica reported allegations of deceptive accounting. Liberty apparently didn't report over $1 billion in member contributions as revenue on its tax forms over several years. Instead, they allegedly put this money in some obscure field, claiming it was funds controlled directly by the members.
But did the members control it?
An accounting expert quoted by ProPublica called that claim dubious at best, potentially illegal, arguing that if Liberty actually controlled the pool of funds, it should have been reported as revenue.
And something about the software they used.
Right. The report describes software Liberty used that created hypothetical accounts. It was allegedly designed to look like individual members controlled their own little pots of money and decided how it was shared. But according to ProPublica, the reality was Liberty controlled all the money centrally in one big pool. An associate reportedly even acknowledged this design was partly intended to help Liberty avoid being regulated as insurance by creating the appearance that funds weren't being pooled by the organization itself.
So, alleged deceptive accounting, software designed to perhaps obscure reality, money flowing to private businesses, while member bills go unpaid. That's the picture ProPublica painted.
It's a deeply concerning picture, and what's also striking is the apparent lack of accountability. Daniel Beers and the family faced investigations, Ohio Attorney General, the IRS, but often settled for civil fines that ProPublica noted were much smaller than the alleged profits. Beers himself reportedly managed to dodge judgments against him for years. The Ohio AG settlement did force Liberty to cut ties with the family, but it didn't fully recover the money members were owed.
And they even tried to use that bank they bought.
Yeah, the investigation describes an alleged plan to use their bank, Lime Bank, to manage HCSM funds using power of attorney from members. This apparently raised red flags with federal bank regulators, the Fed, the FDIC, and led to some bank executives leaving. It just suggests, according to the report, ongoing efforts to manage the funds in ways that maybe weren't fully transparent or subject to oversight.
And Liberty isn't the only example of alleged serious issues, right? The sources mentioned another case.
Correct. Both Wikipedia and ProPublica mention another ministry called Medical Cost Sharing, Inc. Its founders were actually convicted of wire fraud. The reports state they admitted to paying themselves millions, collecting about $8 million in member contributions, paying $5 million to themselves, and only paying out about $248,000 in actual medical claims.
$8 million in, $5 million to themselves, less than $250,000 out to members.
That's what was reported. These examples, the detailed Liberty investigation and the medical cost-sharing conviction, they really underscore the potential risks when you have organizations handling large sums of money intended for healthcare, but operating largely outside the standard financial oversight and consumer protection rules that apply to insurance.
Okay, so given everything we've discussed, the lack of guarantees, the coverage gaps, the regulatory challenges, these incredibly disturbing stories and allegations of financial issues, why on earth do people still choose healthcare sharing ministries? There must be compelling reasons.
There definitely are, and the sources lay them out pretty clearly. Number one, as we keep saying, is cost. For people who don't get ACA subsidies, the monthly share payment for an HCSM can be significantly, sometimes dramatically, lower than the premium for an unsubsidized insurance plan.
That upfront saving is hard to ignore when healthcare is so expensive.
Absolutely. But it's not always just about the money. For many members, the shared beliefs and the sense of community are huge factors. Ministries like MediShare and Samaritan emphasize this, the idea of being part of a group that shares your core values, the prayer support members offer each other. For people whose faith is really central to their identity, joining a healthcare arrangement that aligns with that faith feels right. Feels like true mutual aid.
And some people specifically want to avoid funding certain things.
Yes, that comes up too. King 5 mentioned that some choose HCSM specifically because they don't want their money going towards procedures they object to on religious or moral grounds, like abortions, which faith-based ministries typically exclude from sharing.
And then there's just general frustration with the alternative traditional insurance.
That's definitely a theme. You hear it in the anecdotes, and the market analysis suggests it too. People are fed up with high insurance premiums, high deductibles, narrow networks where they can't see the doctor they want, the complexity of insurance rules, the confusing bills, sometimes feeling like just a number to a giant corporation. HCSMs market themselves as a simpler, more personal, community-focused alternative that appeals to people who feel burned by or just distrustful of the conventional insurance system.
Okay, let's try and wrap up this deep dive into healthcare sharing ministries.
Sounds good. So to summarize what we've gleaned from the sources you provided, healthcare sharing ministries are built on this idea of voluntary belief-based agreements. Members pool money through monthly shares to help cover each other's medical costs. And a primary appeal is often a lower monthly payment compared to traditional insurance, especially for those without ACO subsidies.
But, and this is the giant but, the absolutely critical takeaway from every single source is that HCSMs are fundamentally different from insurance. They operate largely outside state and federal insurance regulations. They lack the crucial consumer protections of the ACA. And most importantly, they do not, under any circumstances, guarantee payment of your medical bills.
Right. And the detailed reports, the investigations, the personal stories, they paint a clear picture of the significant risks that come with that lack of regulation and guarantee. We're talking potential gaps in coverage for essential care, limits or exclusions for pre-existing conditions, annual or lifetime caps on payouts that can be easily exceeded by major medical events, and the very real risk of ending up with crippling medical debt if the ministry doesn't share your costs.
And the regulatory environment is tough, with limited data, constrained oversight. Plus, those specific investigations, like the deep dive into Liberty Health Share by ProPublica, raise really serious allegations about potential financial mismanagement, lack of transparency, and limited accountability in some parts of the sector, leaving members exposed.
So the core lesson really drawn from all this source material you gave us is this. HCSMs might look attractive because of lower monthly costs and that sense of community. But anyone considering joining one needs to go in with their eyes wide open. You must understand you are not buying regulated insurance. You are not getting guaranteed benefits or consumer protections.
Due diligence is absolutely essential.
Crucial. You have to really dig into the specific ministry you're considering. Understand their detailed sharing guidelines, what's eligible, what's not, what the limits are, what their rules are for pre-existing conditions, what their actual track record for paying bills looks like, how transparent they are financially. You need all that information before you even think about relying on them to cover potentially life-changing medical costs.
It's a powerful reminder, isn't it, that the appealing idea of community mutual aid, when implemented in the complex, high-stakes world of modern healthcare, and especially outside strong regulatory frameworks, can carry really significant, potentially devastating risks for the individuals involved.
Exactly. It puts a huge amount of risk back onto the individual member.
So here's a final thought for you, our listener, to mull over based on everything we've unpacked today. We live in a time of really high healthcare costs, immense pressure on individuals to find something affordable. How do we, or how should you, balance that understandable desire for community, for shared values, for lower monthly payments, against the absolute necessity of having reliable, guaranteed access to essential medical care and protection from the kind of financial ruin that unexpected catastrophic health events can cause?
It's a really tough question, a deeply personal decision with incredibly high stakes, and one that absolutely requires understanding the realities and the risks presented in these sources we've discussed.
Thank you again for sending us all this material for this deep dive. We really hope this conversation has helped you navigate the very complex and often confusing world of healthcare sharing ministries.
Yeah, keep exploring, keep asking questions, keep weighing those critical factors. Understanding the nuances here is just so important.
Until next time.